I hope all of you had a good sleep last night. I'm so much delighted and privileged to serve as a moderator for this session. Before starting, I would like to thank you all who have spared your precious time to join us today, and conference organizers for preparing this exciting event. As the title says, this session highlights the role of financial sector and the linkage between financial stability and monetary policy. Indeed, how to address financial stability concerns and how to incorporate them in designing and implementing optimal monetary policy has become the key challenge for central bankers in both advanced and emerging market countries. By bringing together distinguished scholars and experts, we'll try to deepen our understanding on the nature of the linkage and its policy implications. I hope we'll have much to get from this session. As discussants seem to have prepared a designated discussion for each paper, let me organize this session paper by paper. And the first speaker will give about 20 to 25-minute presentation, followed by a 10 to 15-minute discussion. And then we'll proceed to the second paper. After the second discussion, we will open up the floors for questions and comments, and finally, we will return to the speakers for answers and final remarks. Our first speaker is Professor Marcus Brunnermeir from the Princeton University. He is currently director of Bernheim Center for Finance at Princeton. He will give us a talk on the monetary analysis, price, and financial stability. Please welcome Professor Brunnermeir.
Thanks a lot. I would like to thank the Bank of Korea and the organizers for this excellent conference, and also it's a pleasure to be back in Korea. It's a huge success story, the country, and I would like to talk about monetary policy and liquidity flows across sectors as indicated earlier. So the overview of my talk will be the following. First, I will talk about the role of liquidity in monetary policy, and will contrast the standard textbook monetary model with the empirical finance view, how the perspectives differ in this view. We'll make it a little bit more black and white to make it more stark. Then I will introduce the liquidity mismatch, how I define it, and how the liquidity mismatch is distributed in the economy, and how we can capture how it is distributed in the economy. And once I've done this, I will talk about various amplification mechanisms, in particular the liquidity spirals and the disinflationary spirals. And subsequently, I will argue that monetary policy essentially should be taking a view that to identify in a crisis where the bottleneck is, which sectors are balance sheet impaired, whereas the liquidity mismatch showing up and led to balance sheet impairment. And then it should expose, essentially intervene to redistribute wealth in this way. And ex-ante, this can be seen as an insurance arrangement. And of course, as any insurance arrangement, this leads to moral hazard problems and also leads potentially to impaired transmission mechanisms of monetary policy. To avoid this impairment of the transmission mechanism, it's important to have ex-ante strong macroprudential regulations. And in this framework, macroprudential and monetary policy actually work hand in hand, so they're complementary to each other. And one role of macroprudential regulation is essentially to protect the effectiveness of monetary policy. And the emphasis here of macroprudential is very much to identify vulnerabilities and make sure that the system is not vulnerable to financial crisis, rather than identifying what the particular trigger is of a financial crisis. So let me start with a more stylized, stark view between the monetary model, textbook monetary model, and particularly the new Keynesian framework and the empirical finance view. So the textbook monetary model, I think the key friction is wage and price rigidities. So there's mostly a la Calvo, there's some wage rigidity and price rigidity. But on the other hand, financial markets are fairly perfect. I mean, essentially, they're complete markets, they're stable relationships. Of course, there are many models who relax that, but the stylized model has a perfect financial market. And the big advancements in the last decades was essentially to focus On the dynamic aspects, so we had to go away from a static representation to dynamic models and take expectations seriously. In particular, expectations about the short-term interest rate. And the the means there's the most important price, essentially the short-term interest rate. And the long-term interest rates, the yield curve is primarily determined with the expectations hypothesis. So the expected future short rates determine essentially the yield curve. Similarly, for the credit spread, so this was a term spread. For the credit spread, it's the expected default rate. So if you think about it, what drives these prices, these asset prices, mostly cash flow news. If you get new information about future cash flows, that actually moves the term spread and the credit spreads and all the other asset prices around. And that's in contrast to the finance view, where essentially most of it is driven by no cash flow news, but discount rate news. So in the finance view, if it's more empirically driven, and it's very much focused on financial frictions and segmentations of markets, the change in the price is mostly driven by changes in risk premia, and only to a small extent changes by expected future cash flows. So the term spread, the expectations hypothesis fails empirically very starkly, it doesn't hold at all, and credit spreads are mostly driven by changes in risk premia, which we have seen yesterday also holds in international context through the VIX and other things. And that's what I would like to emphasize here, where the risk essentially is generated endogenously. It's not only exogenous cash flow news, the risk is generated endogenously, and also risk premia is time varying. And one particular study which highlights this very much is that if you have surprise interest rate cut, it also affects the 10-year real TIPS rate in the United States. So it's hard to argue that, price stickiness and wage rigidities feed into a real interest rate change 10 years out. And that's indicates that actually financial frictions or liquidity frictions seem to be very, very prominent as well. So I'm not saying that price rigidities are not important. I'm just saying that emphasizing here the other channel on financial frictions. So that's essentially what I would like to start out with. The second thing is what I wanted to emphasize, give you a perspective what I think would be one definition of liquidity mismatch. Liquidity mismatch essentially is the difference in liquidity on the asset side versus the funding liquidity on the liability side. What do I mean by that? If you have a certain physical capital in the economy, there's a lot of physical capital, how easy can you reverse this physical capital? And how long-lasting is this physical capital? If you have a machine which you have to replace every year because it's a one-year machine, it's very easy. You can adjust. You have a lot of adjustability. If it's a 30-year machine, it's much harder to adjust. And that's technological liquidity. That's on the asset side. The other thing is how easily can you replace this machine or shift the machine and readjust it to produce something else. You produce certain widgets, and then you can change the machine and produce cars with it, like some buildings and factories. So there's much more market liquidity. So technological liquidity is how easily you have to replace it. Market liquidity is how easily you can actually shift the specificity of the capital around. How specific is the capital? That's on the asset side. And if it's very specific, the machine, whatever it is, and it's very market illiquid. On the liability side, the question is, how is it funded, this position? Is it funded with short-term debt? You have to roll over constantly short-term debt. Or it can also be funded on margins. If, for example, if you buy stocks and you fund it on margins, and the margins can change every day. So, for example, if the margin is 20% and it can jump to 50%, this means overnight. It means 30% essentially is funded with overnight debt. Okay, that's the same thing, it's just a different language about the maturity structure of the debt. So I wanted to say that what I just outlined here, this market liquidity versus the funding liquidity, holds for physical capital funding, but it also holds, of course, for financial claims, which are claims on some output of a physical capital. So it also holds for financial assets. And, of course, it can be that it goes through a whole intermediation chain. You have this physical capital, then your financial claims on it, and others have claims on the financial claims, and it goes a whole chain of intermediation is going on. And you have to then identify where's the liquidity mismatch showing up. It can be a long, long chain where there's always some liquidity mismatch, and it can be concentrated at some point in the chain. Okay? And that's what you would like to identify. So you look at the whole economy, and you'll get an idea where's the liquidity mismatch, and where the liquidity mismatch is the largest. If there's a shock, then this sector will be impaired and will then react very dramatically because there will be balance sheet impaired. And that's what you have to look out for in order to make sure that the system is not very vulnerable, that the whole liquidity mismatch is not concentrated in certain subsectors in the economy. So that's essentially on the liquidity mismatch. The distribution matters a lot. That's from a static perspective. The dynamic perspective, you have to ask yourself, how do you get to this liquidity mismatch? And typically what you have is you have some build-up phase, what I refer to as volatility paradox. When the volatility seems to be low, then actually this duration of this project, these machines, typically people go into longer and longer projects. So instead of having a machine which you have to replace every year, you buy these 10-year machines. So the projects become more long-term. Hence, the economy becomes less flexible. Or the economy specializes more, the specificity of these machines is going up. So the market liquidity is lower, and because the specificity of the machines is higher, the price impact is much, much harder when there's a fire sale. And at the same time, the debt maturity can shorten. So you have this overall, this aggregate market liquidity, or liquidity mismatch actually becomes more extreme. And that's also, this duration of machines. You can also think this to the Hayek triangle. It's like an Austrian element that the production chain actually lengthened. And with that, the liquidity mismatch in the economy becomes more severe. So on the one hand, you have this buildup of the liquidity mismatch at an aggregate level. And then you also have to identify where this liquidity mismatch is actually concentrated in the economy. And so here's just one example. Here's a very simple example where there's no intermediation chain, but I only have essentially some savers. There's some banks. There issue some inside money to the savers, some equity holding by the banks, and then there's credit extension to the household sector and the corporation sector. And the liquidity mismatch could be concentrated in the banking sector, it could be concentrated in the household sector, and or in the corporation sector. And a particular example is, if you look at the United States in the 2000s, you got a lot of liquidity mismatch and leverage going on in the household sector and through the housing market. If you look at Japan in the 1980s, you have a lot of liquidity mismatch building up in the corporation sector in the 1980s in Japan. And of course, whenever there's liquidity mismatch, the banking sector typically is always part of the game as well. So you see this here when you see the different run-ups of debt levels, so the debt to GDP. So where this is the household sector in the United States, and that's the banking sector, you see there's not much going on. The lower bar is the debt level as a fraction of GDP. For corporations, it's fairly stable, but then you see this run-up of the debt level in the household sector, and even more so in the financial sector. In contrast, in Japan, so here the numbers are different. It's 700% of GDP instead of 350, so it's much more scaled up. You see that the household sector has not much done, so this second area is fairly stable, but the corporation sector had a much larger run-up of debt, and also the financial sector again. So this is important because later on when we do monetary policy, you want to identify where the bottleneck is, or which sector is actually balance sheet impaired. And ex-ante, you want to identify already where is this run-up occurring, in which sectors are concentrated, where the problems are concentrated and potentially are showing up. So what I want to do is I just wanted to show you how this liquidity mismatch might then show up and lead to some amplification, how the amplification plays through two particular liquidity spirals, one liquidity spiral and one disinflationary spiral. So I have this economy showing up here. Let me just, sorry. So this is an economy where there's no monetary policy. That's just a standard economy. Before, the government essentially gives some outside money, some reserves. There's some inside money. The savers hold some of that. And then there's extension of credit to the end borrowers. And if there's a shock, what I want to do is I shock the system. So some of the end borrowers have more troubles paying back to their credit. What happens then to the balance sheet onto the economy? So the first, and I want to split up this shock into 4 steps to identify this amplification. So the first thing is when there is a shock, then some of this credit is destroyed. So some of the assets for the bankers are destroyed. This also hits the equity positions of the bankers. As a second step, if nothing happens, if this credit goes down by 5%, because they are levered, the equity will go down by 50%. Okay? Now, after this, the bankers will be much more levered, and they want to bring the leverage ratio a little bit back again from the previous. So what do? They shrink the balance sheet, and they sell off some of these assets. So they have to fire sell some of this credit, and they have to sell it to somebody, typically the savers, because all the bankers want to sell it. They have to sell it to the savers, but the savers are not so good in lending directly to the end borrowers, hence they're not willing to pay much for that. That's why the price is collapsing. Because the price is collapsing, this means the bankers again make losses because the assets on the credit side, they're worth less. So that's what the liquidity spiral is kicking in. Okay? So that's the first spiral, this amplification, because prices of assets are actually dropping and dropping, which hits the banker's equity on the liability side. The second aspect is that, of course, by shrinking the balance sheets, the bankers also create less inside money. By creating less inside money, the total money supply in the economy is reduced. Because total money supply in the economy is reduced, this means there's disinflationary pressure. Okay? So that means the real value of the money is actually expanding. So that the real value of money is expanding. This means the equity of the bankers is hit again. So both sides of the balance sheets work against the banker's equity. On the asset side, because of the liquidity spiral, prices are collapsing, the banker's equity is hit. But then the bankers try to shrink the balance sheets, because by shrinking the balance sheets, they also shrink the liability side, which means total money supply, inside money creation is going down, the money multiplier is going down. There is disinflationary pressure, which actually increases the real value of the bank's liability, which hits the banker's equity again. So these are the two spirals which amplify, make a small shock, lead to a large effect, and redistribute wealth. So essentially there's wealth destruction, but also redistribution. And the question is, to what extent can monetary policy help to avoid this wealth destruction? That's after a negative shock. Okay? So let me, given the time constraints, jump a little bit. So what I want to do is now, I would like to make the claim is that, okay, what monetary policy can do is can actually, when there is this negative shock, it can essentially redistribute wealth towards the bankers or generally to somebody in order to make sure this amplification is not coming. And I would argue that there are two views. One view is the money view, where they go, the bankers actually shrink the inside money, so total money supply goes down, and they try to replace this missing inside money with new outside money, okay, in order to make sure this disinflationary spiral is not going on. So they actually try to switch off this disinflationary spiral. That's what I call the Friedman-Schwartz money view, and that's essentially what Friedman and Schwartz argued in the Great Depression. You should have really made sure that the total money supply is not shrinking in a broad measure of money. What the money view doesn't fully incorporate is essentially, if the banks are not so well capitalized anymore, they would also extend less credit to the real sector. Okay? The credit view looks not only on the liability side of the bank's balance sheet, but looks more on the asset side of the bank's balance sheet, the credit extension to the real sector. So what the credit view tries to do is it tries to recapitalize the banks rather than just substituting the missing inside money with outside money. It tries to recapitalize the banks in order to ensure there's enough credit flow to the real sector going on instead of banks just holding excess reserves. Okay? The aim is then to switch off the disinflationary spiral and the liquidity spiral on the asset side as well. Of course, it's not a direct wealth transfer. What I would argue that the transfer actually occurs indirectly through changes of asset prices. In order to do this, I generalize the model a little bit by introducing a long-term bond on top of this short-term money. And essentially what you do when you cut the interest rate, by cutting the interest rate, you change the relative value of the long-term bond relative to the short-term money. So let's suppose you have short-term money paying 3% interest on reserves every day, essentially, and the long-term bond pays 5% flat. And there's a relative price between the short-term and the long-term. Now, if you have essentially a reduction in the interest rate of 3% to 1%, the relative value of the long-term bond is shooting up. So if you cut the interest rate sufficiently long, the relative value of the long-term bond is shooting up. And if the banks hold these long-term bonds, we know that the banks short the short-term money, then essentially you stabilize the banking sector. So let me put this in more perspective. So now we have these long-term bonds on top of it. The balance sheet looks a little more complicated. These are the banks. So what happens is if there's a negative shock, then everything would go on as before. The credit, these assets would shrink and all that. But what the Fed can do, or the central bank can do, is cut the interest rate. By cutting the interest rate, you create capital gains on the long-term bond, and essentially these losses the banking system made is compensated with capital gains on the long-term bond. It can be long-term government bonds, can be anything long-term. Okay? So that's essentially how you recapitalize in reality. In this framework, you recapitalize the banking sector. So it's not an explicit fiscal recapitalization. It works through monetary policy by changing asset prices. And we call this stealth recapitalization, and that's essentially what exposed after crisis, what you do here in particular for the banking sector, but more generally, you might look out where's the bottleneck, which sector do we have to recapitalize, and then we change asset prices accordingly. Now we'll come to this when I would say QE2, for example, in the United States, which led to a reduction of mortgage-backed or purchase of mortgage-backed securities, particularly target mortgages, which really try to recapitalize the household sector and push up house prices in order to stabilize the housing sector. Okay, this might have been a totally misguided policy for Japan, but the problem was more in the corporate sector. You would try to do something which really help the corporate sector. So that's essentially exposed. You have this bottleneck approach. What this monetary policy does, it identifies where's the bottleneck, financial sector, household sector in the United States in the 2000s, or in corporate sector in Japan in the 1990s, and then you try to shift wealth around in order to, help out this particular sector. And sometimes you have the problem that you can't reach particular sectors. So if, for example, you might not be able to reach small and medium enterprises because there's no channel to help the banks enough, and then you also don't reach the small and medium enterprises. So the transmission mechanism might be partially broken. Now, from an ex-ante perspective, you can think whenever there will be a negative shock, the banks know they will be recapitalized through monetary policy. Whenever there's a positive shock, there will be some wealth taken away through monetary policy. So ex-ante, it's like the monetary policy rule is like an insurance arrangement. Okay, so ex-ante, it's not so bad. There's some missing markets, but the monetary policy will try to step in and actually try to complete these markets. But by providing this insurance arrangement, the monetary authorities induce potentially moral hazard, and this actually limits the effectiveness of monetary policy, because then the banks say, okay, lever up much more ex-ante, knowing that if something bad happens, the Fed or the central bank will cut the interest rate. Now, for this, actually, that's where macroprudential policy comes in, where essentially macroprudential policy then tries to reduce the risk-taking of the bankers in order to ensure that monetary policy can act on the insurance component in general terms. So when a crisis comes, it can redistribute, and nevertheless, you limit the moral hazard components the banking sector would go into more generally beforehand. The way you would do macroprudential policy in normal times and tranquil times is to have essentially constrain the bankers for going too much into risk, because the bankers might play on this moral hazard, knowing that they will be bailed out through monetary policy exposed. And this might also apply to other sectors as well. The emphasis should be very much on figuring out the vulnerabilities of the system. We know that amplifications are very common. The amplification mechanisms work very similar from crisis to crisis. The trigger varies from crisis to crisis. It's very hard to identify what the trigger is. And it will be a different trigger every crisis, but you have to identify what the amplification mechanisms are, where the system is vulnerable, and the liquidity mismatch I mentioned in the beginning helps you to identify where the triggers or where the vulnerabilities are coming from, and you have to intervene on with regulatory measures at this point. So let me sum up, given that I'm way over time. I just wanted to give you some definition of liquidity mismatch, how the liquidity mismatch might, after a period of low volatility might actually become worse and worse because people go into higher liquidity mismatch. And it is important to identify the risk topography or the liquidity mismatch topography where this distribution of the liquidity mismatch, where it actually is. Because when there is a negative shock, then this will be the sector which will trigger then these two spirals, a liquidity spiral and a disinflationary spiral. In generally, monetary policy in this framework is like a bottleneck approach, ex post. You try to figure out where the problem is, and then you try to intervene where the bottleneck is. And the monetary policy intervention is very much fine-tuned to that. And from an ex-ante perspective, it's an insurance arrangement, and insurance can be excessive. And in particular, if you can't constrain the banking sector otherwise, you might not be able to provide this insurance arrangement. And monetary macro-potential policy help you to constrain, essentially, the bankers' risk-taking in order to provide this insurance through monetary policy in crisis times. So let me leave it at that. Thanks a lot.
Thank you, Marcus. Our first discussant is Professor Javier Bianchi from the University of Wisconsin Madison. He's also a research economist at the Federal Reserve Bank of Minneapolis. You have 10 to 15 minutes.
Okay, thank you very much for inviting me to this conference and to discuss this paper. So the goal of the paper, and I should clarify that my discussion is going to be based on the theory of money, which is the background paper for Marcus' presentation. So the goal of the paper is to provide a unified framework to study financial stability and price stability. So this is a very interesting paper, which is very much at the intersection of money, banking, and macro. And I have only 10 minutes, so I won't be able to do justice to the paper. So what I'm going to do is basically in my discussion is first comment on the mechanisms of the paper, then illustrate some of these mechanisms in a simple Bewley model, fiat money, and then I will provide some comments. So the basic idea here is that intermediaries are going to issue liabilities denominated in monetary units, and they are exposed to aggregate shocks. So when these bad shocks hit the economy, the intermediaries are going to suffer losses, which would lead them to fire sale some of these assets, which through general equilibrium is going to lead to lower asset prices and basically further losses on the asset side. This is the standard liquidity spiral or fire sale mechanism. What is going to be the new element here in the model is that lower money creation is going to lead to a lower price level. Now, since liabilities are denominated in monetary units, the decline in the price level is actually going to hurt the liability side of the banks. And these two spirals, the liquidity spiral and the deflationary spiral, are going to reinforce each other. Whenever you get hit on the asset side, there's going to be also lower money creation, leading to lower prices, and basically leading to more fire sales and more effects on the asset side. And the key takeaway, I think, of the paper is that price stability and financial stability go hand in hand. So policymakers that are concerned with financial stability should attempt to prevent deflation during crisis and vice versa. So now let me walk you through a simple Bewley model of fiat money. I think this is going to help to understand basically the second spiral, the deflationary spiral. So here households are subject to idiosyncratic income shocks with deterministic aggregate dynamics. There's only outside money, which is issued by the central bank. So essentially the problem of the households is to maximize lifetime utility subject to the sequence here of budget constraints, where the money holdings have to be positive. So we can express this in real terms, basically. And one gets is basically a market clearing constraint that says that the aggregate demand for money has to be equal to basically the supply of outside money. And at steady state, one gets basically a quantity theory of money equation where changes in money are going to lead to proportional changes in the price level. Okay, so now let's put a second element here in this model, which is inside money. Now, households are also going to be issuing liabilities and consider real liabilities. And essentially, in the budget constraint, in red, you see these private liabilities issued by the households, and there's going to be a borrowing constraint that I'll show you will have some important effects here. So essentially, if you take a look here at the budget constraint, you can see that inside and outside money are perfect substitutes, which imply that in a monetary equilibrium, the central bank has to follow basically a Friedman rule. And now the market clearing condition is in the asset market is modified to include the demand for inside money in addition to outside money. So now, what are the lessons from this economy, basically? And let's look at stationary equilibria, which is going to make my life simpler. But in the paper, they look at aggregate shocks, and I will comment on that later. So let's say there is a shock to the borrowing constraints. Let's say there's a credit crunch, borrowing constraints become tighter. Well, now the ability to issue liabilities is going to be compressed, which in turn is going to lead to lower private money creation. Okay? So to clear the asset markets, now if there's a decline in private money creation, now the value of outside money has to go up, which essentially means that the price level is going to fall. Okay, so this is the way basically the market reaches the new equilibrium, where again tighter borrowing constraint leads to a higher value of outside money or lower prices. When there is an increase in idiosyncratic risk, it works very similarly. There is, for precautionary reasons, there is a lower private money creation, and again leading to a lower price level. So in some sense, the takeaway here is that credit crunches can lead to deflation. With the caveat that here this applies only to the stationary equilibria. Of course, for the paper, it doesn't have to be the steady state price that basically falls, but the current price level, so that this affects the liability side and triggers this deflationary spiral. Now, if I have to summarize Brunnermeir-Sannikov in one word, I would use the word impressive. It's the modeling techniques are super impressive. There are aggregate shocks, as I mentioned. The banks also have a richer portfolio where they can trade in safe and risky assets. The net worth of intermediaries constitutes the key state variable that is going to determine the endogenous risk and money creation, and therefore also the value of money. And that's perhaps why it's called the I theory of money. It's because the intermediation, in particular the net worth of intermediaries, affects the value of money. And what is also super interesting is that there is a feedback here between the money multiplier and the financial sector. So when the money multiplier contracts, this is going to hit the balance sheet of the financial sector, and in turn, this is also going to hamper money creation and lead to a lower money multiplier. Now, there are other things that the paper do. There's an extension with long-term debt, valuation effects. Marcus also commented on the insurance effects of monetary policy, and I could go on because it's a super deep paper. Now, again, the methods are super impressive, and they build on the author's earlier work. We do things in continuous time. And one can also study this in discrete times, and some people have also looked at full equilibrium dynamics in discrete times. It may be useful to describe a bit the pros and cons of the different approaches. Now, in terms of looking at the real world and thinking about the model, one crucial aspect is whether intermediaries are really exposed to deflation risk. Banks issue deposits in monetary units, so in principle, it seems they are actually quite exposed to the risk of deflation. But there are also lots of financial instruments that banks could use to hedge against this risk. And if they don't indeed hedge against this risk, the question is why don't they do it when there are some instruments available? Perhaps it's because it's not a big risk in the first place, and this does not mean that the theory is not super relevant, because it may be that good policy, as Marcus was pointing out in the paper, could be actually preventing the deflation. So it's just that on the equilibrium path, we don't see it, at least after the Great Depression, but it could be due to good policy. And one aspect also here is that in the U.S. crisis, what caused the decline in the money multiplier was not the holdings of currency by households, but the increase in the reserve ratio by banks. So that was the main cause of the decrease in the money multiplier, which actually fell below 1. And I have done some work with Sakiviji on that. An alternative maybe is that the deflationary spiral is more relevant for emerging markets. As Philip Lane was discussing yesterday, emerging markets are still issuing lots of liabilities in dollars, and this exposed them to basically fall in nominal exchange rates, and that would basically make it more costly to service the debt. So on a more technical note, we know that monetary models are often subject to indeterminacies. And so if you take a Bewley model with only inside money, nominal bonds, essentially what you get is basically that any path of prices could be consistent with a sequence of equilibrium real interest rates. Now, this is a model with only inside money and nominal bonds. In the paper, there's also outside money, so I think it would be useful a bit to explain how outside money helps to determine basically the price level, because this is important for the redistribution effects and the deflationary spiral. So in terms of policy, these liquidity spirals and deflationary spiral create some excessive borrowing, which is a scope for macroprudential policy. I think the model has all the very nice elements and all the ingredients to study a bit more the interaction between monetary policy and macroprudential policy. Let's say that monetary policy is conducted optimally. Well, do we need more macroprudential policy, or it becomes less necessary? I think this might depend also on the ability of the government to commit to both monetary policy and macroprudential policy. So I'm out of time, so let me conclude by saying this is a fantastic paper. It's a very elegant model that provides a unified framework to study price and financial stability. It's also a very nice laboratory to think about other issues, particular thinking about more optimal policy, perhaps. Thank you.
Thank you very much. To use our time more efficiently, let me directly proceed to the second paper, and I will take questions and discussions or comments at the end of the second discussion. So Our second speaker is Dr. Ivan Jacquard, who is an economist in the research department of the European Central Bank. He will give us a presentation on structural asymmetries and financial imbalances in the Eurozone, a paper co-authored with Dr. Frank Smith. Please welcome Dr. Jacquard.
All right, so thank you so much for having selected our paper. It's a great pleasure to be here. So this is a paper, as you said, that is quoted with Frank Smith. So I would like to recall that these are, of course, our own views. This is a conference about challenges for monetary policy. So in this paper, we would like to talk about one challenge, which is, I think, particularly important for the Eurozone. It's this issue of cross-country heterogeneity. So I think we've seen, in the last few years that in the Eurozone there are structural problems. I think by now there is a clear consensus that we need structural reforms in the Eurozone. Now the question is what type exactly of structural reforms do we need? So in this paper we are going to put the spotlight on one particular source of cross-country heterogeneity. So in this paper what I would like to do is to show you a few stylized facts about the Eurozone, to show you what kind of cross-country heterogeneity is really important. And then we'll try to develop a two-country model, a simple two-country model, to try to understand what type of structural reforms could be implemented to try to alleviate these problems. So the first main facts which I think motivated this paper is I think this very famous picture that we see a lot in the Eurozone. So in blue you have the trade balance in Germany, in red the trade balance in Southern Europe. You can see that there is a clear diverging pattern, between trade balances across the north and the south. Something that many people have interpreted as maybe, there is there is not a common cycle in the Eurozone. But at the same time, if you look at output, the second part of the puzzle is that if you look at output, it's highly synchronized. So here I'm showing you output in Germany versus Southern Europe. I think, if you stare at this picture, I think it would be difficult to deny that there is still, a common component that is very strong in the euro area business cycle. Of course, if you look at trends, it would be a very different, it would be a very different story. But if you look at business cycle frequency, I think there is still a very strong common component. Next, another stylized fact, which I think is also interesting. It's also something that has been documented in this literature on emerging business cycle. This very strong correlation between the volatility of consumption and the correlation between the trade balance and output. So here on the x-axis, I'm showing the correlation HP filtered between the trade balance and output. And this is the relative standard deviation of consumption. So what this is saying is that, if you're in a country like Portugal, Spain, for instance, you have consumption that is more volatile than the rest of the euro area. And also on average, you are more likely to have a counter-cyclical trade balance. Well, if you're in Germany or Finland, for instance, consumption is going to be less volatile, and you also observe a trade balance that is more pro-cyclical. So that's, another piece of the puzzle that we would like to take into account when designing this model. Then, we were really now trying to sort of find an indicator of structure that could be potentially explain some of these facts. And one indicator that caught our attention is really this rule of law index. So the rule of law index, captures perceptions of whether agents have confidence in the rules, whether they abide by the rules. It's a measure of the ease at which contracts can be enforced. Here I'm showing you this rule of law index as an average, and here I'm showing the trade balance to output ratio. So see again, there is a very strong correlation between this rule of law index and the likelihood that you will have a trade deficit or a trade surplus in your country on average. So for instance, if you're a country like Greece or Italy, the rule of law index is generally weaker in the south of Europe. So you'll have a weaker rule of law index. Also on average, you will be more likely to observe deficits in these countries. So another striking feature about this rule of law index is that it is also very much correlated with the volatility of consumption. So this is also, that this piece of evidence which seemed to suggest that maybe those indicators of financial structure, they could have a macroeconomic implication. Here I'm showing again the rule of law index on the x-axis. This is the standard deviation of consumption. Again, if you are in a country where the rule of law is weaker, like in the euro area, that would be Greece, that would be Portugal. In those countries, consumption is also going to be, on average, more volatile. So, the next question is, what exactly does it capture? So in the paper, we have a section where we argue that those differences in rule of law, which are really large, in the Eurozone, they are very likely to capture factors that are going to affect the efficiency of financial intermediation. So this is, for instance, a chart that shows you again this rule of law index. And this is an indicator of bank non-performing loans. You see again that there's very strong correlation. Again, these are only 11 Eurozone countries. So these are only suggestive evidence that, we use to guide our research for a model. But you see that, it's very strong. So this is another piece of evidence that suggests that those differences in rule of law, they could capture things that affect the efficiency of the financial intermediation system, because in countries where the rule of law is weaker, on average, you are more likely to observe, very high ratios of bank non-performing loans. Final piece of evidence to give you, really an idea of what this index could capture. Here I'm showing you the number of days that are needed to enforce a contract, and again, this rule of law index. So, this is another dimensions, where in which heterogeneity in the Eurozone is really, really important. So if you take a country like Italy, for instance, it takes on average 1,200 days to enforce a contract in Italy. In Greece, it's a bit less than 1,000, but, after the crisis, this number really increased. In Finland, for instance, this number would be much lower. So basically, so that's our starting point. We were looking for stylized fact. We were just gathering stylized fact to try really to understand what could be those sources of heterogeneity. And the next step was really to try to think about a model that could sort of, summarize all the facts that I have presented. So I'm going to show you what we did. I think once you have stylized fact, there are many ways to think about how to model them. I'm going to show you one particular way to do this. And these are the questions we're asking. So suppose, you believe that common shocks are important in the Eurozone. What is the key source of heterogeneity that could explain these facts that I just showed? What explains this procyclicality of net capital inflows in the South? So we've seen that the trade balance in the South is counter-cyclical. So it means in good time, in Germany, we observe an increase in the trade surplus, which means capital outflows. As a result, in the South, we have a decline. The trade deficit deteriorates, which means that we have net inflows. So if you look at what it implies for the cyclicality of flows, it implies pro-cyclical net capital inflows in the South. So why do we observe this? And does it affect the welfare cost of business cycle fluctuation? And we'll see that the answer is yes. So what we do, going to take like the simplest possible two-country model, and then, introduce this assumption that I've tried to motivate. So in this paper, we are going to, the key source of heterogeneity will be differences in the efficiency of financial intermediation. So our story here is that suppose you live in a country where, the legal system is less efficient, you're going to need like more, say, loan officers, for instance, to do financial intermediation in a country like this. Because, if it takes like forever to enforce contract, if, there are very high ratios of non-performing loans, the production of financial services in this economy is going to be more labor-intensive. So that's how we interpret those differences in the rule of law index. We have data that suggests that indeed it takes a lot more time to enforce contracts in regions where this index is weaker. And that's going to be our key source of heterogeneity. And I'm going to show you that, the simplest possible model with this simple friction is going to go a long way in explaining, some of the facts that were suggested by the pictures I've been showing you. So just to give you a preview of the main findings, so we'll see that once we introduce those differences in financial structure, so we'll have like two financial sectors. One will be more efficient than the others. I'll explain what I mean by that later. We'll see that consumption is going to be more volatile in the region whose financial system is relatively less efficient. So in our model, it will be the south. So, financial intermediation will be less efficient there. And we'll show that this model generates pro-cyclical net capital inflows in the south. And one implication of this pro-cyclicality of net capital inflows is that it will increase the welfare cost of business cycle fluctuation. So then, I will show you like a few policy experiments, and then I will argue that if you could reduce, these asymmetries, make financial intermediation more efficient in the south, the welfare gains would be very large. So I won't have time to talk about the model. Just let me give you the key intuition. So it's going to be like a two-country model. So relative to the two-country neoclassical growth model, here the main difference is that we are going to introduce a financial sector. So as you may know, in the Eurozone, the Euro area is a bank-based financial system. More than 80% of firm financing comes from the financial sector. That's why we had to introduce this financial sector. And the key assumption here is, again, to simplify the analysis, is that capital will can flow across border, but only through financial intermediaries. So that's going to be, to try to make our life simpler and try to really have the simplest possible model that could potentially explain these facts. So here the key assumption is that we will have two types of assets. So there will be one stock of financial capital. So financial capital is an asset that is completely mobile that can be traded across borders. So if you think about the determinant of financial imbalances, it will really be driven by this trade in this financial capital. So this is really what is going to determine the capital account of a country on whether you have net outflows or net inflows. So then the key assumption is that those intermediaries, they are going to produce a stock of physical capital. They will need labor, and they will need to use also this financial capital from their domestic household, and they also need this financial capital from the foreign intermediary. Then this physical capital, so you produce this physical capital, you need this financial capital that you take from both your domestic and foreign sector, and then you produce financial services that will be rented to the firms in the financial sector, and this is how this is something that firms will need to produce. So just let me give you the key friction that we are going to introduce. So here I'm showing you this is the law of motion for this accumulation of financial services. So this is a new quantity of financial services that is produced, and that's our key friction. So you want to produce financial services. So what do you need? You need financial capital. This is this K. It has both a domestic and a foreign component. And in addition to that, there will be this financial multiplier, which will capture the friction that we are introducing in this model. So this is how this multiplier is going to look like. It's going to depend on labor. Again, this idea that if you want to produce financial services, you need loan officers. So potentially by playing with this labor margin, you could increase the quantity of financial services that you will produce. And the key parameter is going to be this technology parameter here. And this parameter is going to determine the steady state productivity of the financial sector. So the idea is that, for instance, if you are in a country with a weaker legal system, it takes a long time to enforce contracts. So for any given loan officer, the quantity of financial services that you will be able to produce because of this weaker legal system is going to be smaller. If you are in a country with very good legal structure, it's going to be very easy to enforce contract. The production of financial services needs to be less labor intensive. As a result, for any given loan officer, the quantity of financial services that you will be able to produce is going to be higher. So that's really going to be our key parameter here. So then, you know, if you look at this trade in financial capital, then you can derive the capital account. Here I'm just showing you the capital account for Germany. So, you know, model is symmetric. So, and then the definition of the trade balance is standard. And we have, as always, the standard balance of payment identity. So just to give you now a bit like some of the main results. So once we introduce this simple friction, so if we look at the steady state of the model, this model will generate steady state in the steady state, a trade deficit in the south, and a trade surplus in the north. So, you know, if you introduce this simple like source of heterogeneity, differences in in the efficiency of the financial intermediation sector, you'll be able to capture, you know, you will be able to get a model with a steady state in which, in the south, on average, you will see a deficit. Now, this is for, you know, like the steady state results. So let me briefly show you what happens around, so how the around steady state dynamics look like in this model. So here, to keep the analysis very simple, we have only one shock, one technology shock that is common across all countries. You know, we motivate this assumption by showing this very high degree of synchronization across the euro area. So that's going to be the response of output to a positive technology shock that is common to all countries. See that, you know, positive technology shock, we have an increase in output. And interestingly, we can generate this sort of diverging pattern of trade balances with this very simple model with only with this main source of heterogeneity. So if you remember, you know, the fact I showed in the beginning, I have a high degree of output synchronization and this negative correlation in net inflows. So this is the response of consumption to a standard technology shock. So, you know, see that in the south, consumption is going to be more volatile in the south than in the north. So just to give you like the intuition for this result, so this is a model where the only tool that can be used to smooth consumption is going to be this financial intermediation sector. So, you know, if you want to smooth consumption, that's the only way to do it is to increase the production of financial services in the financial sector. So now think about, you know, this what happens in the south. You have, you know, this financial intermediation system that is less efficient. So it's going to be much more difficult to smooth consumption in the south because, you know, you are endowed with a technology that is going to be less efficient. So this is just to show you what happens to the production of financial services. So when we have a positive technology shock, you see that the production of financial services in the south increased by much more than the production of financial services in the north. To get this result, we also need to introduce non-standard preferences. We'll need to lower the elasticity of inter-enterprise substitution. So what's going to happen here is that in the south, you have a low elasticity of inter-enterprise substitution. You're really willing to smooth consumption. But, you know, you have this technology that is relatively inefficient, which makes it difficult to achieve consumption smoothing. It's going to increase the precautionary saving motive. So when you have a positive shock, you know, the marginal consumption, the marginal utility of consumption is going to be lower in the south relative to what happens in the north. And this is why, you know, capital is going to flow from the north to the south, to the regions whose relative marginal utility to consume is going to be lowest. So here, this is just to show you that it's a model. It's a very simple model, but, you know, we can still capture some of the main facts that we observe in the data. So here I'm showing you, like, in the north and in the south, I'm comparing the data with the model. So see that, for instance, it's possible to explain this fact that consumption is more volatile in the south than in the north. So these are the main moments that we are trying to match, you know, to calibrate these parameters. And these are, you know, some of the implications that we get from this model. See that it's also possible to generate this pro-cyclicality of the trade balance that we observe in the north. And it's also possible to capture the sign of this correlation, the fact that the trade balance is counter-cyclical in the south, and also the sign of the trade deficit and surplus that we observe in the south and in the north. So it's a model with only one shock, and with these differences in technology as the main source of cross-country asymmetry. So I don't have time to talk about this, so let me just show you very quickly the policy experiments. So now you see what happens in this model. We have those two sectors. One is more efficient than the other. So now the question, what happens in this economy if you were to reduce the magnitude of this asymmetry? So you have a less efficient financial intermediation sector in the south. So what happens if you could do structural reform and increase the labor productivity in the financial sector in the south? And this is what happens. So this picture shows you on the x-axis, this is the financial structure parameter in the south. That's the parameter that captures the degree of frictions. And on the y-axis, we have average consumption in the south and in the north. So at 0.6, this is what happens in the model that is in the benchmark model that explains the data. So see that consumption is going to be lower on average. So this is steady state in the south than in the north. And this is what happens to consumption in the south and in the north if I were to increase this parameter, if I were to make financial intermediation more efficient in the south. And you see, these are steady state numbers. You see that the gains are potentially very large. So this is what happens to the cyclicality of net inflows. So on this picture on the right, that's the response of net inflows in the model with all sources of heterogeneity. If you were to eliminate completely, this particular source of heterogeneity which matters in this model, these differences in financial structure, you see that you would really reduce, the volatility of net inflows by a significant amount. Finally, this is a model where we have like non-standard preferences. So it's a model in which, business cycle fluctuations are going to be costly. So here I just want to show you the effect of heterogeneity on the cost of business cycle fluctuation. So without any asymmetry, so if we took parameters that were completely similar, we would be, since we have common shock, the model, the two countries would be completely symmetric, and this is the cost of welfare fluctuation in that case. So now what is interesting is to see what happens if you were to start from the symmetric benchmark and then, introduce this source of heterogeneity that we have discussed. So what happens now if the intermediation is less efficient in the south? See that it would considerably increase the welfare cost of business cycle fluctuation in the south, and would decrease this welfare cost in the north. Why? Because once you start to have those capital flows, you will see pro-cyclical net capital inflows in the south, which have a destabilizing effect here. And in contrast, if you look at what happens in the north, you have those counter-cyclical net inflows in the north, which act as an insurance. So if you enter a crisis with a trade surplus, if the crisis hits, you don't have to adjust consumption. You can simply reduce lending, and this helps you to achieve consumption smoothing. This is why this cyclicality of capital flows, depending on which side you are, they can either act as an insurance or increase the welfare cost of business cycle fluctuation. So to conclude, what we've done in this paper is to show that differences in financial structures are needed to reproduce some of these facts, some of the facts that we have documented in this paper. So let me emphasize that, we choose this particular parameter because there is a literature that also shows that differences in financial structure matter for the transmission of monetary policy. And in our model, if you introduce those differences with the assumptions, that we have made, it would generate pro-cyclical net capital inflows in the south, which increase the welfare cost of business cycle fluctuation. So, if those differences are really due to differences in legal structure, it could generate imbalances that could be very persistent. So in this, simple model, if we interpret structural reforms as measures that would increase, the efficiency of financial intermediation in the South, it would not only reduce the procyclicality of net capital inflows in the South, but if you look at average consumption level, it will increase average consumption in the South, and it will also slightly increase consumption in the North. Thank you.
Thank you, Ivan. Our next discussant is Dr. Min Jang, who is the Director General of Research at the Bank of Korea. Before joining the Bank of Korea, he has served as Director of Research at the Korea Institute of Finance. Dr. Jang, you also have 10 to 15 minutes.
Thank you for having me here. It's a very great pleasure for me to be here and to read a very nice paper and have a chance to give a comment on this paper. So my discussions include some summarize of this paper and some comments, and I have a very simple extension of this paper's ideas to a different group of countries which have their own currencies. And then, as a conclusion, I give some simple policy implications. So let me first summarize this paper. So the research question of this paper is how the different financial intermediation technologies across countries result in financial imbalances in the euro area. And so the methodology of this paper, they built a two-country DSE model with the heterogeneous financial intermediation technologies. And then they compared the simulated business cycles from the model to those observed in the euro area. And their findings are relatively labor-intensive or low-level financial intermediation technology in certain euro countries causes first a trade deficit, which is a mirror image of a capital account surplus, and second, a countercyclical trade balance, which means a procyclical capital account, and third, maybe the very more important, high volatilities in consumption and hours worked. So they suggest structural reforms improving technology will reduce welfare costs in certain euro countries, and then it will increase consumption in both southern and northern countries. So I think the contributions of this paper is that they suggest structural asymmetries as the main driving forces of the observed financial imbalances in the euro area. And they support their arguments with a model of insight and as well as a very rule of simple. And then they identified heterogeneous legal systems as a main source of the asymmetries in financial intermediation efficiency across countries. So let me give you some alternative explanation for the financial imbalances in the euro area. The first, the possible candidate is excessive risk-taking by European banks, which was suggested by Holinskin and Kuhl and Muisken in 2012. And they argue that after the introduction of the euro system, the certain countries had enjoyed too much low nominal and the real interest rate due to underestimate the sovereign risk before the global financial crisis. So if you see this graph, and then the nominal rates before the euro system, it is very higher in the southern area than in north area. So, but after the introduction of euro system, the nominal rate in south dropped very sharply to the same level of the north area. And then, however, the CPI inflation is still higher in the south part than in north area. So the southern part of the euro system, they could enjoy the pretty much lower real interest rate than in north. So this kind of the interest rate difference is stimulated spending in the south, thereby deteriorated the imbalances in trade or in the consumption. And second alternative explanation I show you here is divergence in price competitiveness, which was suggested by European Commission in 2010. So in this paper, say that during the decade before the global financial crisis, the euro member countries experienced significant and persistent divergence in price competitiveness, and this kind of a price competitiveness is partly driven by wage rigidity, or rather excessive credit growth in private sector, or like housing bubbles. And they argue that divergence in price competitiveness among the Euro countries might have driven divergent export performance. So I skip this part. And so in this graph, so you see the German experience, the depreciation in RER, which shows like the price depreciation, and while the southern Euro countries show appreciation. And the third one, the explanation I think is the risk awareness. Because with the rising risk awareness or rising risk averse sentiment could cause the countercyclical trade balance, because with the rising the risk awareness, you see the distort in credit allocation. So credit conditions have been differentiated, especially for non-financial corporations, especially when they have a kind of a financial crisis. So the increased risk awareness might have triggered a contraction of the interbank markets or retreat of foreign subsidiaries and the branches. And so some academics, some people say, they also suggest how can policymakers have harmonized the financial intermediation technology. So here in the Sapir and Wolf in 2013, they suggested one policy suggestion here, because they think that currently interbank markets are highly integrated while retail banking is fragmented. So this kind of the fragmenting retail banking system results in different credit conditions across countries. So they suggest for government to allow cross-border mergers in retail banking, then it will enhance the transmission of superior intermediation technologies. And in this sense, the banking union will improve institutional harmonization in the banking sector. So this is some other papers regarding to explain the financial imbalances and the financial inefficiencies in Euro area. And here I'd like to show you some very simple extension of this paper. So I borrowed their ideas to apply to the different group of countries which have their own currencies. So, and here, because maybe the role of the exchange rate adjustment might affect the result of the paper, because their papers group of countries have a common currency in euro. So I took about 20 group of countries, mostly G20. Half of them are advanced economies, and half of them are emerging markets. And I found a very similar result. The rule of law indicators seems a very good proxy for the efficiency of the financial structures in these economies as well. If you see the two graphs, then the countries with a strong or maybe higher rule of law index, then in these countries it will need less days to enforce a contract. And these countries have a small portion of non-performing loans compared to the countries which has a low rule of law index. And then consumption volatility also has tended to rise with a countercyclical trade balance in economies here. And then the consumption volatility also has a very, it's still a little bit mild, but anyway, it has a negative correlation with the financial efficiencies showing on the right-hand side of the graph. And this plot shows the possibility that trade balances may become more countercyclical as the rule of law gets smaller in the countries without a common currency. So I think that we could apply the ideas of the importance of rule of legal structures. It has a very big impact on the financial efficiencies and financial imbalances or trade balances as well. So, but I'd like to say that the rule of law, I mean the legal structures, may capture not only the indirect effect of legal structure by the financial channel, but also this kind of the legal structure have a very big impact on overall society's efficiencies, like economic structure, economic efficiencies, and the political efficiencies, as well as social efficiencies. So because the rule of law, like legal structure, is a very strong factor to move the society and the economy, it means that the conclusion, like the financial the imbalances or financial inefficiencies could be measured by the rule of law. Is maybe it should be true, but some portion of their evidence come from because the rule of the law or the legal structure have a big impact on other parts. So the overall efficiencies are reflected in the financial efficiencies. And the other thing is that economic structure, as they showed us, the economies, the legal structures would not improve radically within a short period of time. I show you here the Korea's long-term trends of rule of law index. In the last 20 years, it's improved, but from the 0.79 to 0.94 and 2 years ago. But as you see here, the speed of improving the long-term trend of the rule of law is very slow. And as you can see that it is very hard to catch up with the other countries which have already a higher level of the rule of law. So it means that to improve the financial efficiency and to remedy the financial imbalances or the economic imbalances, we need a long time. We need a time, like more than decades or more than 2 decades, and we need a persistence of policy, and we need a very strong will of government, as well as a very strong will of society, so to go to the next stage. So let me conclude this my comments. So the main result in this paper suggests that improving financial efficiency could bring welfare gains to the economy, and structural reforms over the long horizon would be essential in achieving such goals, like rather than short-term policies. So eventually, the authorities should aim to innovate the social, legal, and economic structures what drives the benefit of the rule of law. I think that this is very important for the countries like Korea to secure the long-term sustainable growth, and then to advance to the next level of stage in the economy. So I think so. As a conclusion, I think that this paper gave us a very important and a very essential the implication to policymakers, how we can to improve our social and economic efficiencies, and how can we secure the long-term growth rate. Thank you.
Thank you, Dr. Zhang, for your excellent discussion and adding your own value added to the paper. I think you should not be here this afternoon because we will be having a monetary policy committee meeting from tomorrow, and he's our key person in preparing the meeting. We now have listened to our both presentations and discussions. And to summarize briefly, in the first paper, Marcus addressed the relationship between price stability and financial stability, which is intertwined through endogenous risk in the financial system. He argues that not only the fluctuation in risk premia, but also sectoral imbalances, such as liquidity mismatch and risk concentration across sectors, are important indicators of potential crisis. In the second paper, Ivan emphasized the role of efficient financial sector in an integrated economy with free capital flows. According to their model, countries with less efficient financial intermediation suffer from higher volatility of consumption and procyclical net capital flows. Thus, structural reforms to improve efficiency of financial intermediation could have important implications for both welfare and financial stability. Now let me open up the floor for questions and for Q&As. If you have any comments or questions for speakers or discussants or on any relevant issues of the present session, please feel free to take this opportunity. we would be grateful if you could kindly identify yourself first before raising a question. Yes. PT, please.
Hello. So I'm PT from the Bank of Thailand. Thank you very much for both sessions. I have a question each for Ivan and Marcus. What struck me is that this session we've tried to discuss study finance, but in the end the models seem to be analyzed in terms of real. So I find this a bit disconcerting because we live in a nominal world. Our contracts are denominated in nominal terms. The constraints bind on nominal values, not real values. So first, with Marcus, one of the amplification mechanisms that you highlighted is that when the price level falls, the real value of deposits goes up, and therefore hurts the equity of banks. Now, I'm thinking, if you think in nominal terms, on nominal balance sheets, I don't see that effect coming on banks. Maybe the fall in the price of assets hurts them in nominal terms, but not the fall in general price level. So I'm curious a bit about that. And for Ivan, the aim of the paper you said was to study financial imbalances, and then you used the trade balance or the current account as a proxy for that, which I find a bit questionable, because I would think financial imbalances, you would think about things like maturity mismatches or credit risk, whereas the trade balance is more like a real thing to me that reflects the structure of production and so forth. So I have a feeling that your paper is more a study about the link between the trade balance and the rule of law, as opposed to financial imbalances in the rule of law. So if you have any comments on that, that would be thank.
Next, Professor Eichengreen.
On the Jacquard-Smets paper, the United States, I'm sure you've thought about this, the United States has a more efficient financial system than China. It has stronger rule of law than China, but it doesn't exactly run a large trade surplus vis-a-vis China. So I think this is a reminder that not everything else is equal, and that the financial system has other functions. In particular, there's the argument that the U.S. financial system is much more efficient than China's at producing safe assets. So question for both presenters. Why doesn't that mechanism work within the Eurozone?
So this is a question for Ivan. The counterpart of a steady-state trade balance deficit is that the country must be a net creditor. And this is a little bit of a problem with Southern Europe, which is not a net creditor to Northern Europe. I was wondering whether this is, in the data, is due to the presence of government debt, and so that's something that you abstract from. So maybe on the private side, this would be more true. And then there's a question whether the interaction with fiscal policy would be relevant and might change some of the results.
Thank you. Alan Taylor, UC Davis. I had a question on each paper. For Ivan, I wonder if you could extend the model a little bit to include not just cyclicality of private consumption, but also government consumption, for which there's also a very big literature. I'm thinking of Jeff Frankel's work and other people's work there. And to some extent, that also seems to have a correlation with rule of law and measures of institutions that we have. So that might add an extra ingredient to your story. My longer comment was for Marcus. So I thought the extension of the model with the inclusion of long-term bonds was really interesting. And I'm looking on the screen here at the data from Schulrich and Taylor. Since World War II, we haven't really done anything with this particular data series, but it's the share of safe government bonds on banks' balance sheets. And it collapses from about 30% right after World War II, around 1950, to around 5% just before the crisis. So that's obviously changed the extent of the insurance they had on their balance sheets. Now there was a large overhang of debt right after World War II for obvious reasons. But the debt hasn't gone away. It's gone on to other agents' balance sheets, maybe asset managers, maybe the households. So that prompted a couple of questions. One is obviously there could be a very rich historical empirical exercise here because you've got big variation in this share over time and across countries where you could explore empirically the channel you're talking about. But I also had a question about theory, which is this a choice variable? Why is it moving over time? Is it regulation? Is it some incentives of the banking system changing? So I'm wondering, in your model, is it possible that something can affect that? Is there some like race to the bottom, or regulation is holding bankers back from trying to shed this safe asset, but over time somehow that changes?
Dr. Choi.
Ongyu Choi from the Bank of Korea. This is a question for Professor Brunnermeir. I think this paper is great to explain the amplification process of financial intermediation of credit cycles or business cycles. I have one comment or question about the heterogeneity in the model. So if we look at the data, we could see a quite conspicuous heterogeneity, in the financial sector, banking versus non-bank financial intermediaries. For non-bank financial intermediaries, they have a severe information asymmetry problem, and they face more diverse, heterogeneous borrowers. So due to such heterogeneity, if there are some negative shocks to the system, and then amplification would be different. Say interest rate hike would have a disproportionate impact on different sectors. So if we extend the model framework, what would be the implication of this inside money propagations when there are interest rate hikes? Thank you.
Well, I guess, just one more question. Okay, Dr. Jinhee Kim.
A quick question for Marcus. You classify the monetary policy theories in money view and the credit view. I think one reason why the money view got popularity, maybe too much popularity exposed, is they have come up with a natural rate concepts like Nehru or natural output or now popular natural rate of interest. I think that's in the credit view or in your I theory or in the finance view, I think if you come up with what's the natural leverage ratio, for example, or natural sectoral imbalances, that would be great. I mean, moderator mentioned the MPC meeting at the Bank of Korea this week, and I'm sure they'll think about the natural leverage ratio for the household debt in Korea. So what do you think, if they have to decide, say, tomorrow and tomorrow, what do they need to look at right now? And for researchers, what do you think the literature should go in the next, say, 10 years? That'd be great. Thank you.
Thank you for asking the question. I should be in the MPC meeting tomorrow. Anyway, let me add I have one question myself to Marcus. Your kind of implicit subsidy or recapitalization through long-term bond, it looks like a bank version of Greenspan put in the capital market, in the sense that it may lead to some moral hazard behavior of the banking sector. You said some macro-prudential regulation may limit this kind of side effect of the monetary policy. Could you elaborate a little bit more on that point, especially what's the relationship between the counter-cyclical capital buffer of the BIS, which seems to have a very similar kind of law with this implicit subsidy through bond market. Okay. Let us listen to response. Marcus first, and then.
Thanks a lot to everybody for this very interesting question, in particular to Javier for his discussion. Let me try to address some of these points. So Javier raised several points whether we could do this in a discrete time framework. I mean, some people have done versions of discrete time settings, but it's way less elegant in a sense. The other question was, why do banks don't hedge their deflation risk if they have it anyway? So they expose themselves to this disinflationary spiral, and there are all these inflation products out there recently where they can use that. And the answer is probably it's an off-equilibrium thing. You would like to be exposed knowing that actually the central bank is helping you out. So you would like to have some duration risk. This duration risk, if the central bank is acting in the correct way, is helping you to be recapitalized. If you were to hedge it away, you would give up this free hedge you get through the monetary policy. I very much like his comments that it might be, more relevant for emerging markets. We haven't thought, what an exchange rate component would add, and it might actually amplify things even further. We also, in terms of monetary policy rules, we have only looked at time-consistent implementation, so everything is subcam perfect. We haven't done any time-inconsistent elements over there. You can't commit a monetary policy rule, and that's something on the agenda we still want to do. And then Pity made some good comments on the real. Why do we focus on the real things? I think when they try to contrast the finance versus, say, the monetary view, I think always what matters ultimately is the real side, and I agree with that. Finance focuses much more on the risk premium aspects, which can still be on the real side, need not be a nominal thing. The constraints can be very much on the nominal side, but ultimately after a sufficiently large shock, it is really the real thing. So it's if your net worth goes down in real value, how much new loans you will extend will depend on the real thing. So, and if the loans are measured in real terms, also the net worth matters in real terms. So going forward, I think to go for the future, the real aspects are very, very important, I think. I agree with Barry on the safe asset, that for the US, as a producer of safe asset, we have a similar phenomenon within Europe, that the German Bund essentially serves as a safe asset, and the fact that it's asymmetrically distributed makes, leads to huge capital flows within Europe. Whenever the crisis becomes more severe, the capital is flowing into Germany. When it becomes less severe, it flows out, and I have made some bond proposal at some point where you try to fix that within the Eurozone. Alan's point about the long-term bond, it is indeed the case, especially in the US, that the bank's long-term bond holding is going down. The government bond holding is going down significantly. It was way, very larger after the Second World War. And here for the analysis, we just introduce a long-term bond, which is a government bond, but it can be anything long-term. It can be long-term corporate bonds or anything long-term. So the analysis would still hold. So it doesn't need to be a government bond. But again, I think I agree that's to some extent, why do banks' bond holding went down so much? We don't have a clear answer for that. In our model, the banks like the long-term bond because that's how you buy the hedge from the monetary policy. We don't have, going to Juan's question, we don't have heterogeneity within the financial sector. This would be asking too much from the model, because essentially we have a lot of heterogeneity within the banks and non-banks, but asking, of course, in reality, you have a lot of heterogeneity within the financial sector, and for policy making, it's very important to take this into account. For example, if you change the term spread on the yield curve, you affect the banking sector, which typically benefits from a high term spread, much differently compared to insurance companies and pension funds. And so within the financial sector, you have to be aware of this wealth distribution monetary policy will have as well. So I think there might be another model to be written just focusing within wealth distributions within the financial sector and seeing what various monetary policies implications are within the monetary policy, within the financial sector. Our paper doesn't go so far. Janelle made a good point about the NIRO, so that's a very valid point. We haven't thought what the equilibrium leverage or liquidity mismatch should be and have a magic number, and it has to, in the long run, go back to that. It might be a nice way to rephrase things and make it more similar to the existing debate on the NIRO, and have, throw some analogies and makes it then, I think, much more attractive for policymakers to pick it up. That's a very good suggestion. And concerning the question on the recapitalization of the banks, so this stealth recapitalization, I think the Greenspan put, so essentially in the early 90s, that's essentially what Greenspan did. He really cut the short-term interest rate. And there was actually a recapitalization going on through the monetary policy of the banking sector. And the special role, as you mentioned, plays the countercyclical buffer. So in particular, in good times, you would like to limit the risk-taking and the leverage of the banking sector in order to have some extra capacity and avoid these moral hazard considerations, which then limits how much monetary policy you can actually promise, or this risk insurance aspect that you can actually promise to the financial system. So let me leave it at that. And thanks again for great questions and great comments from the discussant as well.
Thank you. Next, let's listen to Ivan.
Okay, so let me thank again Director General Cheng for this great discussion. I learned a lot from your discussion. Thank you. So the first question by PT. So I just want also, I didn't have time to, show you the main model mechanism, but I just want to emphasize that we need a very strong propagation mechanism in this model since we have common shocks, and it works through this amplification mechanism. It works through the volatility of asset prices. So there is a role for asset prices in amplifying the shocks in this model. So regarding trade balances versus capital accounts, so within the model we have this balance of payment identity. So I didn't really differentiate between the two, but I agree that in the data it's not clear that we can always use this identity. Professor Eichengreen, that's a great question. So I think that's the first. So when we started to think about imbalances in the Eurozone, so that's the first thing we did. We looked at the literature, and if you look at China, the literature on China versus the United States, I think the explanation there is more that there is relative credit constraint, which explains why China has this. So the US is borrowing from China. For the Eurozone, we had the impression it was more difficult to make this point because the countries that are borrowing are like countries like Greece, Spain. So it's difficult to argue that they are less credit constrained than Germany. So that's why so I think a natural explanation would have been a model with credit constraint, but very, very quickly we realized that for the Eurozone it would not work. So that's why we had to develop this alternative model. Professor Bassetto, so I think I think both Professor Bassetto and Taylor made this point about the importance of fiscal policy. So I think that's, when we finish this paper, that's maybe the first concern that came to our minds. We are abstracting from differences in fiscal policy. Could be a very important factor. So I think all the conclusion, this is something we mentioned in the conclusion of the paper. We should, be aware of the assumptions that we are making. One of them is that we completely abstract from fiscal policy, and we assume that capital can flow cross-border, but only through financial intermediaries. So these are important limitations. Thank you.
Thank you, Ivan. Dr. Bianchi and Dr. Zhang, do you have anything to add? Okay. Well, then this concludes then the first session of today's conference. And I hope the illuminating presentations and discussions this morning contribute a lot to our understanding of the financial and sectoral aspects of the monetary and the macroprudential policies. In closing, I would like to thank you all once again, and please join me to thank all session participants with warm applause. Thank you very much.